Assalamualaikum and hi everyone. Welcome to my channel. I am Madam Yusna Liza, and in our session today we are going to do another question, which is the preparation of consolidated statement of financial position, and we are now going to use question special exam September 2021 from FAR320 that involved the preparation for a simple group where there is only a parent and a subsidiary. And let us look at question one. You should just spend within 40 minutes to finish off the question, so we'll see how we can do it. And let's look at the question here. You have Payable, that is the company that acquire the shares and debentures in another company. So when companies shares were acquired, the acquiree is actually mixed. So this is going to be the subsidiary company and this is going to be the parent company. So that was acquired on 1st of January 2019. So this is the date of acquisition for both shares and debentures. And you have the statement of financial position given to you is as at 31st of December 2020, which is after 2 years of acquisition. So this is the current financial year and this is the date that you're going to prepare your CSoFP for this particular question. Right, so we have the detail on the investment, which is investment in ordinary shares. Investment in ordinary shares is 3.4 million, right? This is the consideration transferred. And you also have the investment that is acquiring the shares. We have to check what are the number of shares being acquired. Another one is the investment in debenture, consideration transferred. And you need to check what is the amount or the debentures being acquired by the parent. You have the current asset here, and you are going to take note on when we prepare the consolidated statement of financial position, we are going to combine asset, liabilities and equity and eliminating the intercompany transaction and also recognizing whatever transaction that should have been recognized as per the group's point of view only. So the intercompany transaction will not be reported in the group statement. So you have the detail there. So we're going to focus on what is the requirement. Let us look at the requirement of the question. So if you look here, you are asked to prepare the consolidated statement of financial position for this company, the group of company Payable and its subsidiary mix on 31st of December. So when you are asked to prepare the consolidated statement, you should start by showing the calculation of Goodwill on consolidation, GOC, or bargain purchase. That was number one. Number two, you should prepare the schedule. When you prepare the schedule, of course, you need to show the workings, and sometimes you may also need to show some consolidation adjustment, to eliminate things or to recognize things that has not been recognized. So that will be done in the schedule to show the non-controlling interest and reserve as at the end of the year. At the same time, the last part is where you will prepare what is required, which is to prepare the CSoFP. So you must make sure that these are included. Don't just prepare the CSoFP. You must show the goodwill calculation and the schedule with the complete workings in the schedule itself. Okay, so let's look at the information given. And for your information, as early as now, this item will not be reported because that is going to be what we invested. And because of that, the ordinary shares will also not be reported for the case of the subsidiary. And at the same time, you would notice that preference shares were also listed there, but you are not informed on the acquisition of preference shares. So this is actually not acquired again, and this is similar to question July 2021. These are all belonging to non-controlling interest, 9% preference shares. And for the item that were being acquired, it is the debenture, so you need to check how much. And for the ordinary shares, you also need to check how much is being acquired. All right, so the rest you are going to go and add them and eliminate in the intercompany transaction when you prepare your CSoFP. Bear in mind that the general reserve, the retained profit, will be included when we prepare the schedule. and also the schedule. Yeah, schedule will also include another item, the NCI, non-controlling interest. So you would see the first information here. So you bought 1.5 million ordinary shares. So you are not informed what is the shares in terms of nominal, the fair value. So you will assume that the fair value is at 1 ringgit since nothing is informed. So you assume at 1 ringgit. So therefore 1.5 million here is actually 1.5 million from 2 million shares. So the acquisition in ordinary shares, holding has 75%, NCI will have 25%. So let's look at the second one, which is the debenture. The acquisition of debenture was where you acquired 200,000 from this 800,000. So when you have that, for the 8% debenture, the holding percentage would be 200 divided by 200. You remember, I'm taking the amount here, I'm taking the units of ordinary shares, divided by 800. So you have 25%. There is nothing to do with NCI because this is not shares, not equity, and we need to look at what belongs to other debenture holder, which is 75%. So it was the reverse of the ordinary shares. So you are also given that information on the retained profit here, and as well as the general reserve. So the information here, this is actually the pre-acquisition reserve, because this is the balance on the date you acquire the share, which is 1st of January 2019. So you acquire the share 2 years after that, only you consolidate the financial statement. So that was for number 1. So we will be using things that in information number 1 to calculate our goodwill first as our first step. Right, let's look at the second one. Second one will also affect the calculation of goodwill, because on the date of acquisition, you will have to calculate what is the equity on the date of acquisition in the subsidiary, and you need to go and calculate the net asset. And the land here was valued at 3.08 million. This is actually the fair value. So for land, on the date of acquisition, the fair value on the date of acquisition is 3.08 million. So you need to reflect the new values, 3.08, because the company Mix Berhad had not adjusted. So you have to adjust during consolidation. So you have to compare with the carrying value. Land is not depreciated. So if you check the land information here, is here, 2.84. So you will compare with 2.84, which is the carrying value on the date of acquisition, is going to be the same because no depreciation adjustment. So 2.84 million. So that will give you a difference of 240,000. This is the revaluation surplus on the date of acquisition, and therefore this is going to be your pre-acquisition revaluation reserve. You need to include this in the equity, so that will be debited to the land of the subsidiary. Remember, the subsidiary here is Mix, I put M, and you will credit the asset revaluation reserve, the pre-acquisition period here. So that was also for M, how much? 240. So that will be done where? In the net asset. That was for land. Now let us look at for the next item, which is our another item, furniture and fixtures, that were 180,000 above the carrying value. So in this particular session, the question that you have for F and F, which is furniture and fixtures, the furniture and fixtures, the surplus is given because you are informed above carrying value. So surplus was directly given to be 180. So you will go and adjust this because this happened on the date of acquisition. So again, the same thing, debit the furniture and fixtures of M, how much? 180, and you will credit the ARR Don't put them together. This is ARR of in M, so 180. So that will be eliminated later on the date of acquisition. However, the asset will be restated at the new values, the fair values. Apart from the surplus that you have to take note that surplus will give rise to an under provision of depreciation by the subsidiary, because subsidiary will be depreciating based on the figure here is surplus, so surplus will lead to an under provision. So under provision, if you check, that was on the date of acquisition 1st of January 2019. So if you see here, 1st of January 2019 is the date of acquisition. This is where you are given the surplus to be 180. After 2 years, then you do the consolidation, 31st of December 2020. And meaning to say that this is the prior year and this is the current year. So you need to go and reflect the adjustment for the depreciation, and you need to do the adjustment for under provision of depreciation for these 2 years. So you are informed on the date of acquisition, remaining useful life was 3 years. So 3 years. So meaning that if it's here, it is 2 years, and by this date it will be 1 year, right? So under provision would be taking the surplus, which is 180, divided by 3 and multiply by 2 years. 1, 2 years, so you will have 120,000, and this will be debited to the it was under provided, so debited to the retained profit of the subsidiary, which is mixed, and credited to the item here was shown at the carrying value. Take note on that, carrying value. So you just straight away go and credit to the furniture and fittings. Do not go and credit to accumulated depreciation unless you are given the cost and accumulated depreciation separately. So that would be 120, and you need to incorporate all this in the calculation of goodwill. And one more information that will affect the goodwill calculation, we have done A. B is information number. C, where you are informed that on the measurement of goodwill is at the proportion of the fair value of the net asset of mix on the date of acquisition. So you know that the non-controlling interest is 25%, so you need to go and multiply with the fair value of the net asset on the date of acquisition when you want to calculate your goodwill on consolidation for the ordinary shares that you acquired. So we'll do D, E, and the remaining later. So let's look at the our preparation of the schedule here. So you can see here I've already done the workings for the holding percentage and NCI percentage, the parent percentage, the controlling interest actually 8% debenture, 25, others was 75,000%, and 9% preference shares that was not acquired, the non-controlling interest was 100%. We start off with the acquisition of ordinary shares, and that was consideration transfer that you paid was how much? 3.4 million. You can check your statement of financial position under the parent, which is the separate one, this one, just to show you again here. Remember, I have highlighted this. Yep. So we have to take that and we include here. Right. Next one is to calculate the fair value of net asset. The first item that you will include is the share capital, but always check if there is any adjustment to the share capital. Here none. If there is, you need to go and adjust in case for the bonus issue that may have taken place out of the pre or post acquisition reserve. And the second information is to reflect the retained profit. No adjustment to the retained profit at the beginning on the date of acquisition. The retained profit is still the same. We are talking about the pre-acquisition profit that was given here, this figure and this figure, the general reserve on the day of acquisition as well. Next is to include the two revaluation surplus So land revaluation surplus and fixture and fittings revaluation surplus, which is the pre-acquisition surplus of 240,000 and 180,000 respectively, and therefore the net asset or fair value of net asset on the date of acquisition is that set 2.74 million, and the non-controlling interest will be 25% from that fair value of the net asset, and that will give you 685, and because of that your goodwill will be on consolidation, which is for ordinary shares, was 1345. Okay, next would be the acquisition of debenture. So if you check again, the acquisition of debenture, the consideration transfer was 200,000. So we have to reflect that here, and the percentage that were acquired in the debenture, which is in the subsidiary, was 25%. Is 25%. And the amount of debenture in the subsidiary was 800,000, the carrying amount. So meaning that you acquired 200,000, which gives you no goodwill. And therefore the total goodwill on consolidation, total goodwill coming from ordinary and debentures acquisition was 1345. And if you look at information number, let's look at which information, on the impairment, information I. This is information I. Goodwill on consolidation, if any. Bargain purchase will not have any impairment. Bargain purchase will be credited to the group profit, but here goodwill is being impaired. So that 1345 million will have to be impaired, meaning that there is an impairment loss. For this impairment loss, debit the group retained profit, which is the retained profit of Fever, with 134.5, and credit the goodwill on consolidation 134.5. So that will be affecting the reduction to this group retained profit. So let's look at the schedule again to reflect that. So this is the impairment. Okay, and you can see that I already prepared the schedule here with the adjustment goodwill column, right? And also the group retained profit, GRP, GGR, group general reserve, NCI is the non-controlling interest. So the remaining goodwill would be 120,500 after deduction of impairment. Next part is to look at the non-controlling interest on the date of acquisition. For the non-controlling interest, you have to put two non-controlling interests on the date of acquisition. The first one is the ordinary shares. The one that you calculated here must be reflected in the non-controlling interest column. And then for the preference shares that was not acquired, look at the preference shares that you have in the subsidiary, and that was 500,000. It was not acquired, and I've mentioned it belongs to the non-controlling interest because it is also an equity. So that will be reflected in the non-controlling interest, which is also part of equity, 100% of it. So now we need to go to the adjustment that affect the retained profit of the subsidiary and retained profit of the holding company, as well as doing the rest for the general reserve. So just make sure that you leave enough space for the retained profit of the subsidiary, the heading, and this one is for the parent, holding, general reserve, and this one is for the subsidiary. So you can see that I have highlighted that in different colors to just make sure that you can clearly differentiate. Okay, so first put the balance that you get from the SOFP. Put the balance, just put the balance that you can take this all. I will show you where from. These are all from the SOFP balance carried forward on the date statement was 31st of December 2020. This one. So I'm taking from here, 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 and here. After you have done that, you need to go and remove for the subsidiary the pre-acquisition profit. If it's a pre-acquisition profit, you will remove by deducting. If it's a pre-acquisition loss, you will add. And this 80,000 was actually the same 80,000 here. It's the same thing. And the same thing must be done for the general reserve of the subsidiary, the one here, which is a pre-acquisition general reserve balance, which is the balance here, right? Then we will think of what is the post-acquisition profit, before the adjustment, the post-acquisition balance, and also here what is the post-acquisition balance. For the general reserve, you are done actually. Why? Because there is no other adjustment that will affect general reserve. You can go and check and you will notice nothing affect the general reserve. It was not used for the bonus issue whatsoever. So if there is the usage of bonus issue using the general reserve, you may have to take note on that and do some adjustment. Here 160,000, 75% belongs to the parent company, to the group, and this 40,000 belongs to the non-controlling interest. So you are done with the general reserve already. Same goes for the parent. There are no adjustment for the general reserve. The general reserve of the group is the balance in the parent plus the post-acquisition share of general reserve in the subsidiary of 120,000. So you are actually done with the general reserve. So you can focus doing on the easy part first, so that you can accumulate marks when you focus the easy part. So now we're going to do the adjustment during the post-acquisition period. We start off with the information that was given. Remember when we were doing information B relating to the under provision of depreciation. We debit the retained profit of the subsidiary here. This one for the under provision, this one. So let me use a different color. Okay, this. When you debit to the retained profit, that will be reflected here. So it has been removed. Next, we go and do the remaining adjustment that have not been done, which is information D. Let's do information D. Information D is on intercompany sale. So mix, which is the subsidiary, sell goods to Fever, that is the holding company. So this is actually the seller here is the subsidiary company. If the intercompany sale of inventory, was the seller was the subsidiary, this is what you call upstream sales. So upstream sales, and it was valued at 200,000, and they charge a profit 25% on selling price. So this is a margin. You may be given a markup, and this is not a markup, this is a margin. So you need to look at the profit, and assuming that the goods that were sold off by mix to Fever was unsold, no information, but you have the information here. Half of this goods still remain unsold. So therefore, the profit was recognized earlier. So now you need to go and make provision for unrealized profit. So you can see that the seller, again, you need to know who is the seller. Seller is mix, the subsidiary. So you need to go and remove in the retained profit of the seller with the unrealized profit. So the unsold inventory was actually half. So it would be the unrealized profit, the URP would be half, was 25% from 200,000, the goods sold, and multiply by half, which is the goods that were unsold. So if you do this, you will get 25,000. So that will be removed from retained profit of mix. Remove that profit. That's why we debit to remove, and you will credit to the inventory of the buyer, Fever. How much? 25k. There is no need for you to go and eliminate the amount owing, because no information saying that there were still paid amount. Nothing was informed. So you just need to do this only. So after you have done that, you can straight away put this in the retained profit of mix, which is the seller. So that is the working. I put the workings here. My advice is for you to put the workings here. 25,000. That debits mean to remove. Next one, we go to the next item. Next item is about bills payable. Okay, for bills payable, this does not affect the schedule. This item affect the schedule. This item you have to adjust in the schedule. But bills payable, you would see that for the bills payable, you need to go and check what is the undiscounted intercompany bills. payable and bills receivable. So you're informed that 45,000 of the bills payable in FAR. So if you go to FAR, wait, yeah, I just need to go and erase this. Okay, sorry about that. Bills payable, yeah, we're talking about bills payable in FAR. So out of this 95,000, 45,000 is intercompany bills, and out of this 45,000, the 1/3, you are informed here, you need to read the question carefully. Yeah, 1/3 has been discounted, so the undiscounted is 2/3. So 2/3 of 45,000. So 2/3 of 45,000. So it would be 2/3 times 45,000. So the undiscounted bill would be 30. For this 30K, you will debit bills payable of FAR, and you will credit bills receivable of mixed to remove the intercompany undiscounted bill. Okay. Next is that you have number F, and but this one will not be affecting your schedule. This will affect, all this will affect the CSoFP. So we'll do that last. Next one is the next item, which is F. We go to F, yeah. F is intercompany sale, of depreciable non-current asset. Depreciable non-current asset. The seller is the subsidiary. Is the seller, because they sold machinery to mix. So this is the buyer. Buyer is the holding company for 90,000. So when the seller sold goods, the carrying value to the seller was 75, but the price or the selling price sold off to mix was 90. So there was a difference of 15 here, 15. And this is the profit that has been charged by FAR. But this profit shouldn't have been charged, because at the end of the year, since there is no information, the machinery is assumed not to be sold off by mix to the third party. So therefore, the earlier part you have charged the profit. So now you need to make provision for the unrealized profit. You need to go and eliminate this. So when you need to eliminate, you need to go and debit the retained profit of the buyer, of the seller here. So I'll be doing this side so that you won't confuse. I just erase this, and it will be doing here. So debit retained profit of the seller here is 15, and that was FAR. So F for FAR, 15. So that must be removed, and credit the item machinery that the buyer is mix, M for mix. So that will be affecting the schedule, SCH schedule again, just like this. Next, you know that when there is an unrealized profit, so if there is a loss, that will be an under provision. When there is an unrealized profit, this will be an over provision. Buyer will have over provided the depreciation or provision of depreciation. So therefore, seller will need to do the adjustment. The adjustment that will be done is to debit the machinery of M, and look at the date. The date is in the current year, so you need to be careful with the date and also the remaining useful life given. So that was all on the date of acquisition. You need to make sure that the remaining useful life and the date of acquisition, date of disposal was the same, or else you need to go and find the remaining useful life on the date of disposal. So credit the retained profit of the seller. Seller here is FAR. How much? That would be just easy, 15. So I will be doing it here. 15 divided by remaining useful life was 3 times 1, because that happens in the same year, so for 1 year. So that will give you the 5K. So let's do this too. This number F. in our adjustment. And remember, we are going to adjust in the retained profit of the parent. So these are the two things that I have adjusted in my consolidation journal. Unrealized profit is deducted. Yeah, remove, look at the carrying value, look at the selling price, the over provision, look at the unrealized profit divided by its fee there, 5,000. Now we go and look at information, which is the next information, which is information on dividend. So you need to always look at which situations are this information related to. In this case, you can see that it was at the end of the year, current year, Board of Directors proposed the following dividends. So this is the parent, and this is mixed is the subsidiary. So mixed declare dividend 182,800, and this has not been recorded because it was proposed at the end of the year, right before the consolidation date. So what you need to do is for the part on figure, this part for this figure, you are going to debit the profit that will be utilized. So retain profit in the statement of changes and equity. If you are doing a consolidated statement of profit or loss or consolidated statement of changes in equity, this will be in the retained profit column of the statement of changes in equity, 182.8, and credit ordinary dividend payable of the parent fever. I just put fever, so that will be reflected in the schedule. Make sure you do that. And this for this part, yeah, this is the one of the subsidiary. So this is for the parent. Now we go and do it for the subsidiary. So the subsidiary, we use a different color. You will go and debit. I'm doing this for the subsidiary, SUB subsidiary. So debit retained profit of subsidiary is mixed. How much given? You don't have to calculate the goodwill that was given. Sorry, not goodwill. This was ordinary dividend. So credit the ordinary dividend payable by mix 72k. But bear in mind, when the dividend was declared by the parent, part of this 72,000 are being shared by Fever, because Fever acquired 75%. So this is actually income from subsidiary. So that must so Fever has not recorded this. So this is situation number 2. So this dividend here is situation, you learn this, right? Situation 2. In the dividend there are 3 situations. This is situation 2. So you need to go and take some of the dividend that were declared by the subsidiary, is 72. So you will remove only dividend payable. 75% of it from 72k will be credited to the parent. So the profit of the parent will be credited, and the income here is the income from subsidiary, the one belonging to Fever. How much was that? That would be the ordinary dividend receivable. So ordinary dividend receivable. So this will be ordinary dividend receivable from subsidiary, and that would be 54 if you take your calculator. Go and take your calculator and calculate, and this must be shown in the SEP later to remove, and this will be shown in the schedule. We will be doing the last information here, which is H, which is the case that Fever has taken credit for its share of interest receivable. So this situation is situation 1, where situation 1, if you can recall, both the parent and subsidiary have recognized dividend or recognized interest. Here is about interest. How do you know? You will check the SEP. So you can see here, 64,000 is the debenture interest payable provided already by the subsidiary, because it has been provided for. And out of the 64,000, you see 16 here, right? So this 16 is actually 25% based on the debenture that you acquired, yeah, percentage. So times 64. This means that the subsidiary has recorded, the parent has been recorded. So this will not be reported. And this dividend, the debenture interest, you will not report 64. meaning that here you need to remove 16, here also you need to remove 16 later in our consolidated statement of financial position. So that will be done by, if you go here, you are going to debit the case here is debenture interest. So therefore what you will do is, this is debenture interest DIP, debenture interest payable, credit debenture interest receivable. So that is if you have not recorded, but here you have recorded, so therefore that would be debit debenture interest payable to remove it, and credit debenture interest receivable under the parent FAR. Here is debenture interest payable under the subsidiary, mix with how much? With the figure that I mentioned to you just now. That was 20, sorry, that was how much actually? We need to go and calculate. 25% from 64K. And that would be 16 earlier, right? So this must be removed. We don't have to calculate, but we are just double checking. So this we have done it, right? And you would also notice that there is one more item here that we have not yet done. The dividend for the ordinary shares has been done. We are not yet done with the preference dividend. So for the preference dividend, remember the preference shares was not acquired by the parent. So this preference dividend is full year. So you are going to provide the dividend debit retained profit of mix. Remember, this is dividend declared by mix. Parent does not have any preference shares. So credit preference dividend payable, that was for full year. For full year means you are going to take the percentage. It was 9%. The amount was 500. You can check 1,000, and that was for 1 year. So that will give you the amount to be 45. So this will be adjusted in your schedule too, right? So now let's look at, I'm doing detail here. We may exceed 40 minutes, but we'll see how. Let's do that and show all the details here. We have done everything. Let's look at what we have in our case here. For the information G, that was regarding dividend. So only dividend payable 72, preference dividend payable information G, just now that we just calculated for 1 year. And to double check, if you have not noticed, where do I take that from? It is from here, 500,000 here, the green part here. Percentage is 9%, and you are informed it was for full year. This was about the full year information. So that's why the calculation is done this way, right? Okay, right, we are done with this. There are no more adjustment for the item in the subsidiary. So we can find the adjusted post-acquisition profit. Take the one of the parent. The parent will take 75%. That is to be shown as part of the group share of profit. And this is going to be the case that will be added in the retained profit and shows the result of the group, deducting with the, of course, the impairment of goodwill that was here. Yeah, the impairment should be included. So impairment, do not forget to include the impairment of goodwill in the group retained profit column. Okay, done with that. So let's look at information G that relates to dividend. Remember, that was just for the parent. Dividend payable, that this one was given in the question. You don't have to calculate. So we debit just now retained profit of FAR. And another item here is because when subsidy declared earlier 72, parent will have a share of how much? 75%. That would be the case here from mixed. So this is the case. So adjusted post-acquisition profit of the parent, adjusted post-acquisition profit of the parent would be 841,200. We include in the group pro column, right? So done with that, we can total up for this section of the group retained profit. Make sure that you include everything, right? The total would be the total here, and the total of the group profit so as 1,870,200. the total for the NCI. Okay, the next stage is to prepare our consolidated statement of financial position. We have done the schedule. So what you will do is, I mentioned, you are going to add, and then you are going to do the elimination. So this will be added. This one will be eliminated, as I mentioned. This will be added, and we need to look at whatever intercompany transaction that we have done. Here there is no item that relates to goods in transit or cash in transit. No item which asks you to adjust for the accounts receivable whatsoever. So debenture, we also will be doing the consolidation, leaving just the one of the parent and the one relate to the other debenture holder. To take note on this bank overdraft. For this debenture interest payable, will not report all 64, will just report the remaining figure after deduction of this, right? And remember, the bill debenture interest receivable will not be reported, but you must show the working. So we just do that. First, just to add just list down that asset that you have, yeah, goodwill. So here is the working that I will show one by one here. The first one is, you can also see the, yeah, you can see my workings. I also provide some details in the box there relating to the explanation. So the first item is surplus for the revaluation surplus of land. So you can check here for details. Fixtures and fittings, you add the parent and the subsidiary, you plus the surplus, and you remove the under provision. So the explanation is here. You need to recognize and increase the under provision. Plant and machinery, this was the case that no changes except for the unrealized profit and debenture that was being over provided. You can check this here, eliminate URP and decrease depreciation, right? That was over provided. And goodwill is the remaining goodwill here. So we just show the goodwill. Next is the current asset. So the current asset, remember I've mentioned that debenture interest receivable will have to be eliminated. So you can see that I deduct the intercompany debenture interest, so there was no figure there. Inventories, you need to go and adjust with the unrealized profit. You can check the notes that I put here, all these little notes here. It can be good worth explanation to you. You can read this later. Account receivable, no changes because nothing to eliminate, right? Just add them, parent of the and the subsidiary. Same goes here. Bills receivable, you need to go and eliminate with the intercompany undiscounted bills, which is the elimination being done here. And take note, the bank, nothing is to be adjusted, just add. For the issued and paid up capital, you will show just the one ordinary shares. The preference shares are being eliminated to the when the acquisition was not acquired by the parent. They are all belonging to the non-controlling interest. So the preference shares are here, actually, here in this non-controlling interest column. The reserve part is quite easy because you have done that earlier. So just put the general reserve figure that you calculate here and the retained profit together with the non-controlling interest. So put them under the equity section, right? And the non-current liabilities, you will reflect just the one of the parent and remove the one that were being acquired. This 200 is the one being acquired. And for the current liabilities, the first one, accounts payable, just add bills payable, eliminate the undiscounted bills. For the item bank overdraft, nothing for you to do, just 320,000. Where is it? It is actually here, right? So all this must be included. Next one is the item which relates to debenture interest payable. I have mentioned earlier, you just need to remove the 16 because there was income from subsidiary. So you can see I put a note here, eliminate interest payable to parent because this is situation 1. The next one is I'm simply splitting two things here. Can check this here. I'm showing the preference dividend payable by mix, and these are all to the non-controlling interest. Since you can check information G, the parent company did not acquire the preference dividend. So The parent company did not acquire the preference shares, so no rights to get the dividends. So everything belongs to the non-controlling interest. Next one, I'm splitting the ordinary dividend payable by FIVA 180, 82, 800, the one here, this one, right? And you will see that I put separately the ordinary dividend payable by mix to the non-controlling interest. 72 is the one here, and eliminating the income from subsidiary 54. So what you show here is the dividend payable by mix to the non-controlling interest. That's it. We are done with this question. Special exam, September 2021. With that, I thank you for watching. I'll see you when I will see you again in the next video. Thank you for watching. Until then, Assalamualaikum, and have a pleasant day ahead. Thank you.